Welcome to Taxplained, explaining taxes so you can minimize your tax burden and maximize your freedom. The profit split method operates by dividing the combined profits or losses from a controlled transaction among related parties based on each party's relative contributions. These contributions are assessed through a functional analysis that takes into account the functions performed, risks assumed, and assets employed by each entity. There are two main types of profit split methods used in transfer pricing, and that's the pure profit split and the residual profit split. Both approaches involve sharing profits, but differ slightly in how they allocate profits and assess the contributions of each party in the transaction. The pure profit split method divides the total profits or losses earned from a controlled transaction based upon an agreed upon allocation formula. This formula is derived from the relative value of each party's contribution to the overall profit. Typically, contributions are measured based on certain objective factors such as labor costs, time spent, market risks borne, and value added. In this approach, the profits are shared proportionally to each party's role in the generation of profits. The pure profit split method is most appropriate when both parties contribute equally significant value, such as in joint ventures or in partnerships where both entities perform complementary functions or share critical intangibles. The residual profit split method differs in that it first allocates a routine profit to each party involved in the controlled transaction. Routine profits are the returns that could be expected based on the functions and risks typically undertaken by each parties. These are usually determined by reference to comparable transactions between independent parties. Once routine profits are allocated, the remaining profits, the residual, are split between the parties based on the relative contributions of each to the residual value. These contributions usually involve non-routine intangibles such as intellectual property, unique assets, or proprietary technology. The residual profit split method is often applied in industries where significant intangible assets play a key role in value creation, such as the technology or pharmaceutical sectors. The profit split method is typically used in the following scenarios: where there are highly integrated operations, when the controlled transaction involves highly integrated activities where both parties contribute significant value to the transaction, where there's intangible and proprietary knowledge, when both parties bring unique non-routine intangible assets that contribute to the profits, joint ventures or alliances, in case where two related entities share the risk and rewards of a joint enterprise. This method is particularly useful when other methods, such as the comparable uncontrolled price method or the transactional net margin method, are not appropriate because of the complexity or uniqueness of the transaction. In the pure profit split method, profits are allocated entirely based on a predetermined or negotiated formula that reflects each party's contribution to the transaction. This can be in terms of tangible assets, risks, or other factors deemed relevant. The method assumes that all the profits or losses can be attributed directly to the shared contributions of the parties. The residual profit split method, on the other hand, first allocates routine profits, which are calculated based on benchmark data from independent entities. These routine profits are typically based on the typical return one would expect for performing routine functions such as contract manufacturing, distribution, or administrative services. The remaining profits, or the residual, are then split between the parties based on their respective contributions to the intangibles or other non-routine assets. The pure profit split is most appropriate when both parties contribute systematically or symmetrically in equal measure to the overall success of the transaction. This may be the case in strategic alliances or joint ventures where each party shares equally in terms of capital, risks, and operational input. The residual profit split is better suited for situations where one party performs routine functions and the other contributes unique, high-value intangibles. This method is common in industries where intangible assets drive profitability and where the routine returns need to be separated from the exceptional profits generated by proprietary technology, patents, or brand value. The pure profit split method tends to be less complex as it applies a formulaic approach to dividing profits. However, determining an appropriate allocation key, such as the relative value of inputs, can still require careful judgment and justification. The residual profit split is generally more complex due to the need to determine an appropriate routine return for each party, followed by the allocation of residual profits. Additionally, splitting the residual profits often requires a deeper analysis of the non-routine intangibles and the contributions they make, which can of course introduce a bit of subjectivity. The profit split method is a valuable transfer pricing approach for multinational enterprises engaged in complex, highly integrated transactions. Both the pure profit split and the residual profit split methods offer distinct approaches to profit allocations depending on the nature of the transaction and of course the contribution made by each party. The pure profit split provides a straightforward approach for dividing profits based on predetermined criteria, making it useful for joint ventures and other equal partnerships. The residual profit split, on the other hand, is more suitable for cases involving non-routine intangibles or where routine returns must be allocated first. While the profit split method offers flexibility and fairness in profit allocation, it also prevents challenges, particularly in terms of subjectivity and data availability. Businesses applying the method should be prepared to justify their profit allocations and provide robust documentation to support their approach. As global tax authorities continue to scrutinize transfer pricing practices, the profit split method will remain an important tool in ensuring compliance with the arm's length principle. At its core, the resale price method uses the selling price of a product or service, also known as the resale price, and adjusts it based on the gross margin earned by independent resellers in comparable transactions. The gross margin in this case is calculated as gross profit divided by net sales. The aim is to ensure that the resale price charged by the controlled entity, such as a distributor within the same corporate group, falls within an acceptable range of gross margins observed in the open market. For example, if a US-based distributor buys tennis rackets from a related entity in China and also buys similar shoes from an unrelated third-party supplier, the gross margin from the third-party transactions could be used as a reference to ensure that the gross margin from the related party transaction remains within a comparable range. This prevents distortions in profit allocation between different tax jurisdictions, as might occur if the Chinese supplier sells the tennis racket at an artificially high price to minimize taxable profits in the US. So when do you use the resale price method? The resale price method is typically used in transactions involving tangible goods, especially when a distributor or reseller is involved. It works well when there are reliable gross margins from similar products and market conditions. However, this method may not be appropriate for transactions involving intellectual property. A key advantage of the resale price method is that it allows for minor differences in the characteristics of the products being compared. For instance, a distributor may sell the same product in different colors or slightly varied designs, yet the overall gross margin would remain comparable. This flexibility in product characteristics makes the resale price method suitable in cases where the exact same product is not available for comparison. In that case, the comparable uncontrolled price method would be more appropriate. While the resale price method is effective when applicable, its use is constrained by the availability of reliable data. One major challenge in applying the resale price method is ensuring that the gross margins from third-party transactions are truly comparable. For instance, accounting differences across countries, particularly in the way they classify costs of goods sold and operating expenses, can really skew gross margins and affect the transfer pricing analysis. Additionally, The resale price method may be less effective when there are no comparable third-party transactions to serve as benchmarks. Another challenge is the complexity that arises in multinational transactions. Tax authorities from different jurisdictions may interpret the application of the resale price method differently, particularly concerning which gross margins or product variations are deemed comparable enough. So what are some of the benefits and drawbacks of the resale price method? The benefits first. The ease of use. When appropriate comparable transactions are available, the resale price method offers a straightforward and effective method for determining arm's length pricing in intercompany transactions. There is some flexibility in comparability as the method allows for minor differences in products, making it more versatile than the comparable uncontrolled price method, which requires nearly identical products or services. There's also the clear allocation of profits, as the resale price method focuses on the gross margins, ensuring that distributors within a group earn a comparable return to independent parties, making the profit allocation more transparent. Of course, there are some drawbacks. Data limitation being the big one. The most significant drawback is the reliance on comparable transactions. In industries or regions where such data is unavailable or difficult to obtain, the resale price method may not be applicable. Well, the variation is accounting, of course. Differences in how companies record costs of goods sold and operating expenses, because this can distort gross margins, which potentially leads to the misinterpretations of comparability. Of course, there is the limitation to tangible goods, as this method is generally limited to transactions involving physical goods and may not be suitable for intellectual property transactions or service transactions. So maybe let's go into a practical example of the application. So consider a scenario where a distributor buys electronic devices from a related party in one country and unrelated third parties in another. Under the resale price method, the gross margin earned by the distributor in the uncontrolled transaction with the third-party supplier serves as the benchmark. If the distributor earns a gross margin of 20% in the transaction with the unrelated supplier, the same margin should apply to the controlled transaction, thus ensuring that the price is consistent with the arm's length principle. The resale price method plays an important role in transfer pricing, particularly for transactions involving tangible goods between related parties. Its strength lies in its ability to ensure that distributors earn a reasonable profit margin compared to what they would achieve in an open market. However, the method's effectiveness is highly dependent on the availability of reliable comparable data and the consistency in accounting treatment across companies. While the resale price method offers some flexibility regarding product characteristics, it requires careful consideration of gross margin data to ensure arm's length pricing. As with any transfer pricing method, understanding its limitations and proper applications is important for compliance with global tax regulations.